Have you ever wondered why some people wake up seeing their assets double, while others lose everything overnight because of the market? Are stocks just a legalized casino for the wealthy, or a practical path for you to escape the daily grind? The uncomfortable truth is that many people lose, not because they lack money, but because they lack understanding of the game and lose control of their mindset. And I promise that after this video, you will view money as a tool, not as a gamble. 1. The ownership rule. It's not a piece of paper, it's a piece of the pie. Many people hear others shouting to buy low and sell high, but they truly don't understand what they are buying. A stock is fundamentally the right to own a piece of a company, not just buying a fluctuating number. Imagine the company is a chocolate cake, and each share is an extremely thin slice. When you buy one share, you are saying, "Let me invest and take a portion of this company's pie." Companies can have very different numbers of shares outstanding, and that number can change when the company issues more or buys back shares. So don't just look at the price of one share, look at the whole cake, which is the total valuation of the business. Why would the owner sell off pieces of the pie to strangers? Because they need capital to expand factories, develop products, or conquer new markets. And the money raised from selling shares usually doesn't need to be paid back like debt, making it an option less stressful than dealing with interest rates. 2. The market rule. Your gain or loss depends on who you sell to. If I want to sell, who buys my shares? The answer lies in the marketplace and the concept of liquidity. When a company sells shares for the first time to raise capital, that is the primary market. After that, most of the time you are buying and selling with other people. That is the secondary market. Simply put, the company receives the money during the initial sale, but afterwards you and I are swapping pieces of the pie with each other in the marketplace. Therefore, cashing out means selling your shares to another buyer, not always selling them back to the company itself. And the daily price fluctuations are often just the crowd's sentiment valuing the pie, not the business fundamentally changing quality every minute. If liquidity is low, you might find it hard to sell or be forced to sell cheap, so understanding the market is as crucial as understanding the company. 3. The value rule. The story of Amy and Brian, and profit is not magic. A woman named Amy wants to open a sneaker store and needs $100,000 to start. She only has $50,000, so instead of taking out a loan, she divides the business into 10 shares and sells some off to raise capital. A guy named Brian buys one share for $10,000 and owns 10% of the business, meaning he has a true ownership stake. 5 years later, the business booms and the company's value increases from $100,000 to $300,000, and Brian's share increases in value accordingly. Brian only truly makes a profit when he sells that ownership stake for a higher price than he bought it for. If Brian hasn't sold, that is profit on paper, called an unrealized gain. When Brian sells at a good price, that is when the profit actually lands in his pocket and becomes real cash. Conversely, if the business fails and the value drops, Brian's portion drops too, and that is the risk that comes with the opportunity. Some businesses also distribute cash periodically to owners called dividends, meaning you can receive cash flow even if you haven't sold. 4. The power rule. Regular tickets or VIP passes in stocks. Not all stocks are the same, because rights and the order of payment can differ. Common stock is like a regular ticket, the most popular, and usually comes with voting rights. You can vote on major decisions, but if the company goes bankrupt, you are typically near the end of the line to receive money, meaning the risk is higher. Preferred stock is like a calmer VIP pass. It often has few or no voting rights. In return, it may have priority in receiving dividends or priority over common stock in receiving funds in certain situations. So the question isn't which type is better, but do you want aggressive growth or stable cash flow? 5. The psychology rule. Differentiate risk and volatility to avoid acting like a gambler. Many people confuse volatility with risk because they panic when they see red and get high when they see green. Volatility is the price moving up and down that makes your heart race, while risk is losing money long-term or permanently. Historically, there have been periods where the market dropped extremely low, like the 1929 crash, and those who panic sold permanently lost the opportunity to recover. There was also the dot-com bubble around 2000, which made those who bought at the peak based on blind faith cry tears of regret. But the fastest killer is not bad news. It's the combo of fear of missing out, FOMO, and fear of loss. FOMO causes you to rush in when everyone is cheering, usually near the emotional peak. The fear of loss makes you cut your losses exactly when you are most terrified, usually near the bottom of despair. The delusion of skill makes you think you're a genius after a few winning trades, leading you to increase your bet and then get wiped out in one major hit. Recency bias makes you think that because this week was green, next month will also be green, just like trusting a weather forecast for your entire life. The poor often get poorer because they invest based on emotion, while the rich get richer because they invest according to a system. The lesson applicable in every country is to set your rules before you place a trade, not while you are panicking. 6. The fee rule. The invisible enemy of compound interest is cost and overtrading. You might choose the right company but still lose if you pay fees like scattering change along the road. Fees are like a small hole in the bottom of a bucket. It doesn't hurt immediately, but slowly drains your compound interest over time. There is a very real phenomenon where many people trade constantly just to feel like they are working, but they are actually feeding fees and suffering from slippage. And there was a famous bet lasting over a decade that proved the low-cost strategy usually beats the high-fee strategy, because fees eat away consistently, like termites. The lesson applicable in every country is to reduce fees, trade less, and let time do the heavy lifting of compounding. 7. The survival rule. Diversification and an emergency fund to stay in the game. If you put all your eggs in one basket, you aren't investing. You are playing an all-in, winner-take-all style. Historically, some businesses that were once very popular still collapsed, and those who poured all their assets into one stock suffered the deepest risk. Diversification means spreading your money across various sectors, regions, and asset classes, so that one fall doesn't break your entire career. An emergency fund means you have enough cash set aside to live for a period, so you are not forced to sell when the market is crashing. Rich people aren't necessarily smarter, but they are better at avoiding early death thanks to diversification and cash flow discipline. The lesson applicable in every country is that the biggest win in investing is being allowed to stay in the game long enough. Conclusion: simply and clearly. In summary, when you buy stocks, you buy ownership in a company, not a red or green game. Remember 3 things: understand the pie, understand the marketplace, and manage your mindset. Start with your emergency fund, then invest regularly, reduce fees, and maintain diversification. If you want me to make a follow-up video about index funds, rebalancing, or how to build a system for investing without guessing the market, comment the keywords below. And don't forget to hit the subscribe button to slightly increase your financial IQ every day, letting your money work for you.